Welcome to a quick update on the back of the price volatility or market fear that seems to have consumed investors over the last couple of weeks. In terms of our thought process and whether there in fact has been a disconnect between underlying fundamentals and price action in the market, I would encourage you to just again reread our quarterly report and our monthly report where we detailed some of the issues that are impacting markets at the moment. But I guess bottom line is that the price action has been more severe than we would have expected, and particularly in light of what we've seen from earnings reports over the last month, and also just our general observations of the US and European economies, which continue to edge along. And as we always said, we thought we're in an environment where you're going to have two steps forward, one step back. The one step back being always when you get this sort of growth scare in the market. 18 months ago it was Greece, now it's China. China's a bigger issue, but we still think ultimately that will be seen as another growth scare. In terms of our own positioning, clearly if we had foreseen this sort of price action, we probably would have reduced some of our positions. But our basic philosophy in terms of investing money is that if we believe businesses can return a satisfactory return over the next 3 to 5 years, we're happy to own those businesses and look through any short-term gyrations in the market. Now at the end of the year, we highlighted that we believe markets are re-rated. The return expectations for the market overall were lower, and as a result it would be all about earnings and dividend yield. But again, we expected a satisfactory return outlook over the next 3 to 5 years, albeit a lower return outlook, and that is why we're happy to maintain our invested positions. So the question we ask ourselves now is that, have those return expectations increased because clearly prices are lower, or is there something out there in the market that is creating this fear that investors have been reacting to? So in terms of fear, it seems to be all macro driven. As we've noted before, people are now assuming that China is in fact going to be worse than they expected. We've seen the impact in the collapse in the oil price. That causes severe stress in places like Russia, the Middle East, even the US shale producers. So you're going to get defaults in terms of oil companies, high-cost producers, but overall I don't think it's going to be a big issue. The reality of life is that the collapse in oil price is very, very positive for consumers in developed markets, and I think what you're seeing now is the short-term impact of the disruption, but when we come back in 12 to 18 months' time, you'll actually see the positive benefits from the fact that the oil price, or more particularly the petrol price, is a third lower than what it used to be. So the economies seem to be still stable. Earnings reports are very, very good. Probably the only change since our monthly and quarterly reports is the fact that the Japanese moved to negative interest rates. This is a big mistake. The Japanese just don't seem to understand that they need structural reform. Monetary and fiscal stimulus no longer works. But I think from a market perspective, what has compounded the fear over the last couple of weeks is that people then began to worry maybe the US heads down that path. We don't believe that will in fact be the case. Negative interest rates just does not work. We generally need structural reform now, making sure multinationals pay their fair share of tax and getting rid of all the regulatory red tape. But bottom line is, we think you'll continue to see slow progression in the economies, and that will provide a base for earnings growth, and as I said, that will create an acceptable return for equities, particularly against bonds and cash, which are basically giving you no return. So bottom line is, we believe there is a disconnect between current fundamentals and price action in the market, and therefore we would suggest that would be an opportunity. And I guess if we look over a long period of time, both at our own experience and the experience of others, the reality of life is that you look for these sort of opportunities when price action is greater than expected on the negative side, that typically is an opportunity to put cash to work. And it's really the psychology that you've got to deal with, because as we all know, the lower prices go, the more people convince or become convinced that they're going to go lower. When the reality of life is that the lower prices are, the better the expected outlook for investment returns are over the medium to longer term. And that's really what our philosophy is all about. So has the price action of recent weeks changed our outlook for our core investment themes? The short answer is no. In fact, everything we've seen from the earnings reports have reinforced our belief in the ultimate outcome of these businesses. Probably the most topical is obviously the banks, because that's really the centre of attention. And when people get fearful about the economy, banks are the obvious targets. But if you actually look at the fundamental news that has come out over the last month or two, it is very supportive of the trajectory that we expected for these businesses. First, we had the UK authorities come out and communicate very aggressively that UK banks had now raised enough capital. And that to us was always a very important inflection point. Then we had ING come out with their result. Capital is now in excess of what they're required longer term. As a result, they announced a big cash dividend, and that stock now sells on a 6 to 7% dividend yield. Exactly what we were suggesting 6 and 12 months ago. And again, in an environment where bond rates are 0% in Europe, that is a big spread against the cash alternative or the bond alternative. And over time, I'd be very, very surprised if that's not arbitraged by the market. And then in the US, the earnings, the key thing we were looking for was loan growth, and JP Morgan in fact came out with 16% loan growth, which is very, very strong. So the fundamentals seem to be very, very supportive. Obviously the price action has been at odds with that. It's always hard to tell which one is right short term. But it was interesting that the other day, Jamie Dimon from JP Morgan purchased $25 million of JP Morgan stock, indicating that the CEO of that bank clearly thought that there was in fact a big disconnect between current fundamentals and what was happening in the stock market. So whether that turns out to be a great buy or not, time will tell. Short term, the banks have obviously reacted to that. But all we can tell you is that the story continues to play out exactly as we expected, and our history of investing tells us that when the fundamentals continue to support our outlook, that in situations like this, you need to stand firm and don't let the market force you into doing something that you really don't want to do. And that's really what I've observed over the last couple of weeks, is that the fear factor has increased dramatically, and people really are fixated with short-term macro issues as opposed to the underlying fundamentals. If we go to other investment themes in our portfolio, US housing, European real estate, our monopoly service providers, right across the board, the earnings reports have been very, very good. So again, there's no reason to change our outlook. And that's why we lean to believing that what we've seen in the market over the last couple of weeks is more of an opportunity than a risk. Now, one area that we haven't been invested in, and has come down a long way on the back of China, is obviously the resources sector. And so we're getting a lot of questions about that. Until this point, we've resisted the temptation to move into the resources sector. But the fact of the matter is that a lot of those stocks have now come down a long way, and it's definitely worth having a look and doing the research. Now, I still think that they're going to have a difficult environment, so we might have sharp trading rallies, but I suspect we'll come back in 2 or 3 years' time and they've gone sideways in a wide band. But oil in particular, and to a lesser extent the pure commodities, are definitely worth putting on the radar screen short term. In respect of our invested position, we're currently roughly 100% invested in equities, and we also have a 20% position in debt securities, which we have recently added to, given the blowout in high yield debt. We treat that as really being funded by our ability to borrow low cost and therefore earn a little bit of a spread for the portfolio. But in terms of the equity portfolio, we're fully invested. The price action doesn't change our view on that. It's more about a question of mix for us going forward. But in terms of our underlying philosophy, I just reiterate that we're all about can we find businesses that will generate a satisfactory return over the next 3 to 5 years, and if we can, we invest our capital into those businesses. And the fact of the matter is that given the price action of the last month or two, the expected return outlook for those businesses has now increased dramatically for individuals who are wanting to put cash to work. So we see the current environment as more of an opportunity. Clearly there's a lot of fear out there. I would remind investors of Peter Lynch's famous quote, the day after the market crashed in 1987, people began to worry that the market was going to crash. So again, look forward, don't look backwards. And in terms of those advisors or investors that may have been considering us as a potential fund manager, we would argue that this is the perfect environment in terms of creating an entry point. If you look back over time, the trick about accumulating capital in excess of the market is a combination of both obviously picking the right stocks, but also picking the times of when you actually put capital to work. And when you get short-term opportunities, or what we believe is a short-term opportunity to do that, the wise thing to do is obviously to put that cash to work rather than react to the fear that is now present in markets.